You're a quant, and quants love models. You have two models. One predicts the change in price and the other predicts the volatility. For one stock in particular, you believe the price will go up, and the volatility will too. You'd like to put these predictions to the test, but you only have limited cash on hand. What's a quant to do? Buy options. Options give you leverage and allow you to test out your ideas. Things are going well. The stock increased in price and you'd like to realize some of those gains. But what about your volatility prediction? You'd like to let it run because your model says there are further gains to be made. Should you sell your options? You don't have to choose. There's a way to lock in your profit from your price prediction without selling your options. This allows you to hold on to your options and wait for your volatility prediction to kick in. There's a way to isolate these two variables, but to do that correctly requires you to speak a little Greek. The Greeks, that is. Let's meet our cast of characters. Delta, Gamma, Vega, Theta, and Rho. These are the key Greeks in options trading. Yes, we know Vega isn't actually a Greek letter, but let's just say it snuck into the fraternity and nobody had the heart to kick it out. In a nutshell, these Greeks let you measure how an option's price changes with different factors, whether it's the underlying stock price, volatility, time decay, or interest rates. But before you start applying them to your trades, we need to understand how each of these works in detail. Trust me, learning a little Greek now will pay off later. While we're at it, we'd like to invite you to meet one more important Greek, Socrates, good friend of ours. He was a great thinker and inspired us to create Socratica. You can learn more by visiting Socratica.com. There's an established methodology for determining the price of an option. For European-style options, you use the Black-Scholes equation. This takes in a few key inputs and tells you what the option should be worth. American-style options are a bit more complicated. There's no single formula. Instead, quants rely on more subtle techniques, like binomial trees or numerical models, to account for early exercise. But in both cases, the key variables are the same. The price of the stock, the time to expiration, the risk-free interest rate, and the volatility of the stock. The first three are more straightforward. You can look them up. If you ask around, you'll get the same answer from everyone. But volatility is different. Volatility is where opinions and opportunities begin to diverge. It's a critical factor, but it's not directly observable. You have to estimate it. And different people, using different methods, make different estimates. That's why two quants can look at the same stock at the same time and come up with different prices for the same option. The price of an option can be written as a function of several key variables. Quants often use C for the price of a call option and P for the price of a put. Here, we will use V for value because everything we say applies to both calls and puts. And now it's time to meet the Greeks. These are numbers that measure how V changes relative to the inputs. Mathematics already has a way to do this with a tool from calculus called derivatives. A derivative tells us how much the output changes compared to a change in the input. If the function has only one input, we use the D notation for the derivative, but when there is more than one input, we can take the derivative with respect to each variable individually. That is called a partial derivative, and we write it with a curly D. Partial derivatives let us isolate the effect of each input on the output. In options trading, the Greeks are partial derivatives in disguise. Specifically, partial derivatives of the option's value with respect to the different variables that drive its price. Delta measures how much the value of an option changes when the price of the underlying stock changes, all other things being equal. If delta is 0.5, then the change in the option price divided by the change in the stock price is 0.5. This means for every $1 the stock goes up, the option's price will go up about 50 cents. If the stock drops $1, the option's price will drop about 50 cents. Delta is the partial derivative of the option's value V with respect to the stock price S. Why does the option's value change with the stock price at all? All other things being equal, changing the stock price changes the gap between the stock price and the strike price. If you're holding a call option and the stock moves closer to the strike price or further above it, that option becomes more valuable. If it moves further away, it becomes less valuable. A put option works the same way, but in the opposite direction. Suppose you have a call option worth $5 on a stock trading at $100. Let's see what happens with a delta of 0.6. If the stock rises $2 and nothing else changes, the option price will increase by roughly $1.20. So the option will now be worth about $6.20. That is the power of delta. It gives you a simple way to estimate how an option will react to small stock price movements without having to rerun a full pricing model every time the stock ticks up or down. Theta measures how much the value of an option changes as time passes. This is known as time decay. If theta is negative 0.05, then your option loses about 5 cents in value every day, even if the stock price, volatility, and interest rates stay exactly the same. Mathematically, theta is the partial derivative of the option's value v with respect to time t. For most options, theta is negative. After all, the less time you have, the less chance there is for the stock to make the move you need. It's like planning a road trip. If you start with a full day, you can reach all kinds of destinations. If you only have an hour, your choices shrink. Suppose you own a call option worth $4 with a theta of negative 0.08. That means each day that passes, the option loses about 8 cents in value, purely from time decay. After 5 days, if nothing else changes, it will have lost about 40 cents in value, so it would now be worth roughly $3.60. For option buyers, theta is an enemy. It steadily erodes your position, even if the stock price does not move. For option sellers, theta is an ally. It's the reason you can profit even when the market seems to stand still. Vega measures how much the value of an option changes when the volatility of the underlying asset changes. In calculus terms, Vega is the partial derivative of the option's value v with respect to volatility sigma. Here's the tricky part. Volatility is not something you can look up. It's an unobservable. You have to estimate it. And different traders will estimate it differently, which is one reason they often disagree on what an option is worth. So how does volatility affect an option's value? First, higher volatility means the stock price is more likely to make bigger moves. That means there's a greater chance the stock price ends up well above the strike price for a call option, or well below the strike price for a put option. In other words, the possibility of landing in a favorable payoff zone is bigger. But there's a flip side. Higher volatility also increases the odds of a big move against you. Vega does not care about direction. It only measures the impact of volatility on the potential for large moves in either direction. For example, suppose you have a call option worth $2.50 with a Vega of 0.12. If your volatility estimate rises by 3 percentage points, the option's value will change by about 36 cents. So the option would now be worth roughly $2.86 if nothing else changes. Vega matters most for options with more time until expiration because with more time, volatility has more opportunity to produce large price moves. As expiration approaches, Vega shrinks because the window for those moves is closing. Rho is the Greek that measures how much the value of an option changes when interest rates change. Mathematically, Rho is the partial derivative of the option's value v with respect to the risk-free interest rate r. What does this entail? First, risk-free rate. This is the rate of return you can earn on an investment that is, in theory, free of default risk. In practice, we use the yield on short-term U.S. Treasury securities as a proxy. They're backed by the U.S. government, so they're considered essentially risk-free for most financial modeling. Why would interest rates affect an option's price? Think about the nature of a call option. It lets you delay paying for the stock unless and until you choose to exercise. During that delay, you can earn the risk-free rate on your money. If interest rates go up, that delay is worth more because you can keep your cash invested at a higher interest rate before you need to spend it. So, rising rates tend to increase call option prices. For put options, the effect is reversed. A put gives you the right to sell stock in the future, but it only pays off if the stock drops. In the meantime, you're holding onto a contract that may or may not pay off later. If interest rates rise, holding cash becomes more rewarding. That makes the put less attractive because instead of earning interest on your money, you're waiting on a potential future payout. So when rates go up, the value of a put option usually goes down. Put differently, the opportunity cost of holding a put increases when rates go up. Suppose you have a call option worth $5 with a Rho of 4. If the risk-free rate rises by 1 percentage point, 0.01 in decimal form, the option's value changes by about 4 cents. So the option would now be worth roughly $5.04 if nothing else changes. How important is rho in practice? Not very, at least not for most short-dated options in today's markets. Interest rates don't change dramatically from day to day, and the effect on price is small compared to the other Greeks, delta, vega, and theta. But for long-dated options, or in times when interest rates are moving quickly, rho can become significant. So far, the Greeks we've seen, delta, theta, vega, and rho, all measure the immediate rate of change in the option's value with respect to a single variable. To put this mathematically, they are all first-order partial derivatives. Gamma is different. Gamma measures how delta itself changes when the stock price changes. In other words, it is the second derivative of the option's value v with respect to the stock price s. You can also write it as the derivative of delta with respect to s. Why is this significant? Because delta is not fixed. As the stock price moves, your delta changes, sometimes quickly, and gamma measures that. A high gamma means delta can shift rapidly with even small changes in the stock price. A low gamma means delta is relatively stable. Suppose you are short a call option with a delta of negative 0.5 and a gamma of negative 0.04. If the stock price rises $2, your delta will drop by about 8 cents. So your new delta will be roughly negative 0.58. How would you use this information? When delta changes, you might need to adjust your portfolio to keep your risk measures in check. Traders who manage large books of options monitor gamma closely. High gamma positions require frequent rebalancing, which means more transaction costs and more sensitivity to sudden moves in the underlying. Low gamma positions, on the other hand, are easier to manage because the hedge stays in place longer. Gamma, as a second-order partial derivative, is your first glimpse that we are not limited to just first-order Greeks. Options have a whole hierarchy of higher-order Greeks that describe more subtle aspects of how their value responds to changing market conditions. Gamma is simply the most heavily used of the higher-order group. Let's bring it all together. The Greeks, the option price, and you. At the center of it all is the price of the option. That's our V, the value. Surrounding it are the four main forces that shape that value: the price of the stock, the volatility, the time remaining, and the risk-free interest rate. Each of these pulls on the option price in its own way. And now, you know which Greek measures each one. Delta connects the stock price to the option value. Vega tells you how sensitive the value is to volatility. Theta captures the effect of time. And rho shows how interest rates play a role. These are the big four, the core Greeks. But they're not the only ones. There are even second-order Greeks, like gamma, that help you manage more complex risk. Options are powerful and subtle. Understanding the Greeks gives you control. To go deeper and learn more, visit Socratica.com and explore our course offerings.